Good afternoon, everybody. Thanks for joining us today. We've got a very exciting installment of our webinar series with Charlie Bilello here. We're looking closely at the bear market, and we're going to find some honey, right, Charlie?
Yeah, we're going to try. Yeah. Our first bear market webinar. It's exciting. Yeah.
That's true. That's true. Hopefully the last. I guess we'll get into that. Yeah, for anybody new joining us that doesn't already know everything there is to know about Charlie, you should. CEO and founder of Compound Capital Advisors. Follow his blog, follow him on Twitter. He's always putting great content out. Keeping everybody aware of what's happening in the markets and why it's happening. And he's got the best charts in the business. So keep an eye on Charlie if you aren't already. But we've got an action-packed agenda today. We're going to talk about cash, everyone's favorite portfolio holding right now. We'll talk about the bear markets and past bear markets and how they're all different. Spend a little bit of time talking about the state of the consumer, the housing bubble, which we've talked about several times over the past, several months or so. We'll look at the only path to long-term prosperity. So interested to dig into what that is. The upside of downside, I think that's when we'll get into some of the honey. And then we are committed to saving some time at the end for Q&A. So with that being mentioned, let's jump right in. All right. So our first topic, when cash is king. Charlie, talk to us about the slide here. So I'm seeing a disappointing, returns over there on the right-hand column, but let's dig in.
Yeah. So cash, as you know, for a long time has been viewed pretty negatively. There is no alternative kind of acronym, TINA, that people used to talk about for a long time, and for somewhat good reason, because yields were nothing and stocks seemed to be only going in one direction, up. But this year we're seeing the flip side, where cash has really been one of the few places to hide in a portfolio. And if you have a portfolio of stocks and bonds, it's really the worst year we've seen in a long time, where we haven't seen double-digit losses in both stocks and bonds in a calendar year ever. And so we're on pace for that today, with bonds down 12% and stocks down a little over 20%. There's still time left in the year, but cash so far has been king. And then so the big question is, okay, this is the past, of course, and what does this mean going forward? Should you just hold cash forever? And how should investors be thinking about it from this point forward?
So before we jump into the next slide, Charlie, we're getting a couple comments from the viewers. Cash really is, I guess, if you look at it on a purchasing power adjusted level there, we're what, down maybe 4% year to date?
Yeah, if you're inflation adjusted. Yep, yeah. Sure. That's right. So these are all
still nominal. The best performer, but not quite flat.
These are all nominal returns. Yeah, that's right. They're not inflation adjusted. That's correct. And so I think these two tables tell a really important story to give context for how different this year is than really any year we've seen in the recent past. And the left table there is just showing you 60-40 returns. So 60% in the S&P 500, 40% in the Barclays Aggregate Bond Index, and how that fared since 1977, which is as far back as we go with the Barclays Index. And as you can see, down 17% this year. There's only one year that was worse, and that was in 2008, down 20% for the full year. The difference being between now and 2008 was dominated all on the stock side. Right. So you had big losses, 37% decline in stocks that year. And that really drove that big loss in 60-40. As you can see from the right table, the last 8 years that were down for the stock market, the S&P 500, bonds were actually higher in every single one of those years. And that really cushioned the blow for investors. And this year, we're not seeing that. Of course, we're seeing stocks and bonds go down together, and double-digit percentage declines in each. And so why is that? Why the different behavior? We talked about it on the last webinar, but it's an important point for investors to think about is when you have the cause of the stock market decline, at least the proximate cause or primary cause of the decline being higher inflation rates, then you have interest rates tend to rise during those periods and rise pretty quickly. And as you know, interest rates rising, bond prices fall. So very different behavior. Typically, when you have a deep bear market in stocks, you have interest rates falling because people think that growth is going to slow. You have deflationary pressures. And we may end up seeing that at some point during this cycle. We're just still in the phase where people are most concerned with rising inflation and rising interest rates. And so you have this decoupling in kind of the historical relationship where bonds, at least in the aggregate, haven't providing that safety. You have to be very short duration, as we've been talking about, to kind of protect yourself against that possibility happening. And now it's happened. And so all of last year and early this year, we were saying, well, why is the 10-year still at 1.5%, even 2% if inflation? And now we're seeing very quickly a readjustment in that. And so it didn't make much sense at the time. And, kind of the notion the bond market is the smart money. They're expecting something. Maybe they're not expecting inflation to be as high or stay high. But that ended up being wrong. It was, whether it was the Fed buying those bonds or international investors coming in and buying treasury bonds because they were higher yielding than their own bonds. Many different factors could have been pushing that rate lower, but that was kind of a false signal. And now we've seen an adjustment, and that's been painful, right? So when you're starting at zero, the important point is when you're starting at zero in terms of interest rates. So 10 years at, 30 basis points at the lows in 2020. When you're starting from there, when you go up, then 3%, you have no cushion. There's no coupon to protect you. So it's pretty much all price depreciation. So it's much worse to go from 0 to 3% than it is to go from 10 to 13% in terms of an interest rate rise. Your duration is higher, and that means you're going to be hit more on the downside. So for all those reasons, this has been the toughest year for 60/40 since 2020, and the toughest year for bonds in history. If the year ended today.
Charlie, just to park on this one for a second, because this is actually something we've been hearing from our clients a lot, which is, meeting with your clients in the first quarter of the year when a 60/40 portfolio is potentially down even more than an aggressive, 80/20 or even 100% stock portfolio. It's a difficult conversation to have. Any anecdotes or anything that you would add to that conversation with the investor in a 60/40 portfolio to explain or kind of help ease that pain a little bit?
In terms of explaining why what happened, or
well, I guess,
how they should feel better.
Yeah, maybe. Yeah. I guess maybe explaining it, but maybe even just talking about how bonds have done their job. Looking back at 2020, I think we talked about the stock market when we first saw that contraction from the COVID situation being down about 40%, but the 60/40 portfolio being down, much less than that, in like the 15% range for that short period of time. But maybe reflecting on how bonds have done their job in the past. And if you look at oil and what that was doing to your portfolio a few years ago, you probably weren't very happy with it either.
I think, Caleb, I can't tell you, because I've been in the opposite camp of that. You shouldn't be, you should treat your bonds differently when they're yielding nothing, that now they're more risk. And, even in a risk off environment, you could have that potential. But, I think, for investors, what they should take away from that is that every time is different. And that just looking, even if we looked at the last 8 bear markets, you would have predicted, right, that bonds would be up this year. We can't just do that automatically. You have to look at the risks of the reasons for stocks going down and weigh those different risks, right? And I think we were in a unique situation, last year and coming into this year with kind of obvious inflationary pressures, but bonds only down a little bit. And you could have done one or two things, to hedge yourself against that. One would just to be saying, well, they've done their job historically, and so we'll just stick with it. Or two, you take some action. And now at this point, it's a harder question, right? You got 10-year at 3.5%, and perhaps it will be more of a hedge if the stock market goes from being down 20 to down 40, right? Perhaps at some point, then the fears will be deflationary, right? You have stock prices coming down. No, that's a deflationary pressure. Home prices are likely to correct. That's a deflationary pressure, right? The Fed is unwinding their balance sheet, and deficits are getting small. So all of these factors are moving the other direction. Maybe at a certain point, bonds, start behaving more like they have traditionally. But I think that the takeaway, Caleb, would just be very careful in just taking what's happened in the past and kind of projecting that into the future, because every situation warrants its own analysis, right? And you had to go back a long time to see the type of behavior that we've seen. And we saw it in the early 1980s in terms of declines. We just didn't see it in the year-end results. So you see that 1981 there where, stocks were down, but bonds were up. Well, bonds did have a big correction when interest rates rose. Interest rates came back down, and the yield you were getting was so high back then that the rise in interest rates was over. Like, very quickly, you made your money back just from that coupon. So very different animal today, right? As we've talked about.
All right. Thank you. So speaking of historical periods.
Yeah. So, two important points here in terms of, again, saying, okay, just because something hasn't happened in the past doesn't mean it can't happen in the future, right? Every year we see these seemingly outlier moves in markets and events and things that have never happened. So on that list is we've never seen the S&P and 10-year Treasury down double digits together in the same year, with cash outperforming both of those asset classes. And that's what we're seeing so far in 2022. This is data going back to 1928. So we have a lot of different environments here, a lot of different cycles that we're talking about. And so an investor today will be tempted to say that, let me just stay in cash forever, right? And why do I need to take any risk at all? We know the reason is over very long periods of time, stocks have delivered higher returns, right? 10% per year on average over 100-year periods. Bonds have delivered 5%, in cash around 3%, and more recently, not very much at all, right? So if we look at the tables on the left side, it really tells you why, if you're a longer term investor, holding cash is a risk in and of itself, because as you talked about, you're losing that purchasing power, right? It's much harder to keep pace with inflation when you have your money in cash. And so if we look at the percentage of the time where cash is the top performing asset class out of stocks or bonds, as measured by the 10-year Treasury, over 1 year periods, it happens 13% of the time. So, not often, but not totally out of historical context what we're seeing here. It's really just the magnitude that's been different. But as you go on, 3 years and you go on to 5, 10 years, and even to 20 years, there's never been a 20-year period where cash has outperformed both stocks and bonds, right? So if you're a very long-term investor, holding cash, it's a matter of time before that becomes an underperforming position, and you have to weigh the different asset classes and saying, well, what's the probability of cash outperforming over a period of time? But with 10-year now at 3.5%, the calculation's different. It's going to be harder to outperform that going forward with cash, right? With stocks down, 20%, presumably, and we'll talk about this later, they're cheaper than they certainly were at the start of the year. Future returns should benefit from that. And so again, harder to beat than it was, right? So if you're a long-term investor, I don't think now's the time. You never want to do things after the fact, but cash might continue to outperform for the next year, 2 years, certainly during the Depression. It could go on for a few years. We've seen in bear markets in 2000 to 2002 as well. But at a certain point, something's going to flip, either the bond side or the stock side, in flipping that equation, right? Because if the recession gets bad enough, then you're going to have deflationary concerns. Interest rates will come down. Bonds will kind of settle in and likely outperform. And if it's a shallow recession or no recession, which is becoming less likely by the day, then perhaps stocks rebounds, right, and they'll outperform, right? So one of the two things is going to happen with the passage of time.
The big question is which, right?
Yeah, Yeah, sure. And that's why you have a diversified portfolio, right?
Right. All right. a lot of questions about bonds and interest rates. Maybe we'll get to a few more at the end of the webinar here, but let's move into, something that you've already alluded to, which is, you can't look at past bear markets and understand what that means for this one because they're all different. So went the wrong direction there. There we go. So let's talk about a few, but start with what's going on.
Start with this year, right? And here we go. We're down 22.5% from the peak early in this year. So we're officially in bear market territory. And what do we do whenever you're in a bear market? I do it too. Everyone, looks for that historical analog, right? What is this similar to in the past? And that will perhaps instruct us what will happen next about the future. The difficulty with that, of course, is if you look at this table of historical bear markets, which should jump out to you immediately, is the huge variation, right? We have 1 month bear markets like we saw in 2020. We have 33 and 36 month bear markets that we saw in the 1930s and early 1940s. We have bear markets that stop at around 20%, and we saw that in 2018, 2011. 1990, 1998. And then you have bear markets that are longer and deeper, right? 2000, 2002, 2007 to 2009, most recently. So the question then becomes, well, what is it most similar to? What are the similarities and differences with this recession versus other recessions, right, in the past? And a lot of that hinges on whether we're going to enter a recession or not. So the average decline during bear markets around 36%, but it's over 40% if you're in a recession, and it's under 30% if you're not. These are just averages, right? So if we know whether we're in a recession or not, that's somewhat helpful because the recessionary bear markets tend to be longer and deeper. But other than that, it's very difficult to say. And even within that, there's huge variations, right? So in 1990, we had a recession, but the bear market stopped at 20%. We're already past that today, right? And the bear market back then was only 3 months, and we're already longer than that today, right? So this is just a point that there's really nothing you can pick and say it's going to match exactly with that historical bear market. Every single time is going to be different. And as we'll talk about in a little bit, this bear market's very different so far in terms of what the Fed's response has been than any that we've seen in recent history.
And here's the last few, right?
Yeah. So I put a few different slides. This first one is one type of bear market, which is the short, what I call the short and shallow bear market. So, a few months in duration. And then you have a very quick move back to new highs. And if you could pick any bear market, we don't want any bear markets, of course, but if you could pick one going in, you'd say, I want this one, right?
By the dip bear market, right?
Yeah, essentially. It's a big dip, but still you get to that low and then very quickly the market runs back up, right? So the most recent example being 2020, which I think surprised just about everyone, how quickly it went back to new highs. But you just didn't have this long drawn out process, right? Investors felt that pain very quickly, and then very quickly they were rewarded if they added to risk. And even if they didn't look at their portfolio, they were back at new highs. So that's one type of bear market. And on the next slide, we have what's really feared, which is kind of the long and deep bear market. And we have a few examples of those in recent history. Everyone remembers the financial crisis, 2007 to 2009 bear market. Stocks were down 58%. 2000 to 2002, after the dot-com bubble peaked, another 50% bear market. And if you go back further, if you're around in the 1970s, 73, 74 is one people always talk about as being just a long, punishing 50% decline for the market. And the commonality here coming out of these is they all took years, not months, to get back to new highs, right? So the losses were deeper. you just had investor sentiment really capitulated at these lows, and it took a long time to recover, right? The math of losses really works against investors too, where it just takes much bigger gains to come back, and that tends to take more time in general.
Charlie, in that bottom chart there, that dreadful bear market from 73 to 74, heard some comparisons to where we are right now, because that was another situation where rates were rising pretty rapidly. Is that one of the patterns that jumps out as most analog to where we're at now?
Yeah, you could pick this one or the slide on the next slide, which is 81, 82, I think, in terms of the inflationary concerns being the proximate cause of that bear market. Those would be the two that come to mind. And this is the third type of bear market that I talk about, which is what I call the steady drip, which it's not a huge decline, 28%, but it took a long time getting there. It took 22 months in this case to go from high to low. So would you rather have this or 73, 74? Probably this. It's just a lower, smaller decline. I guess if you're a longer term investor, you'd rather have the bigger decline. It'll allow you to buy in at lower prices. But these would be the two really front and center where it was really the last time you had the Fed with hawkish monetary policy in the face of a bear market. And so that's a good segue into that table at the bottom there, where I illustrated, anyone who's investing in markets the last 40 years has kind of only known one response from the Fed. And that's really just almost immediate easing. As soon as you see stocks down, approaching that 20%, in many cases, even before it reached 20%, you just saw the Fed either responding by cutting rates or doing quantitative easing or some combination of the two. Or if they were hiking rates, they would stop rates as we stop hiking, as we saw in 2018. So the response has been pretty much textbook. Like, you see stocks going down, doesn't matter if you're in a recession, right? We were in a recession in 2018 or 2011 or 1998 and or even 1987 during the crash, but it started really under Greenspan, and that what became known as the Fed put. And the Fed would come in and try to save the day. Right now, we could debate whether that was the right thing to do or it was even effective in what they were trying to accomplish. But that's the kind of backdrop that you had for the last 40 years. Is you're going to have easy monetary policy as the solution for lower asset prices and often cases economic weakness associated with that. The Fed's going to come in and ease policy. This time around, very different, right? So we're already down 20%, and tomorrow the Fed's going to hike rates again. Now there's the odds of a 75 basis point hike tomorrow has really jumped in the last few days. It's now 95% probability. And as we talked about, the Fed likes to please the market and do what the market expectation is. So I think there's probably a pretty good chance they do it. If they don't do that, they'll do 50 basis points, of course. But the bigger story here, though, is the market's pricing in now enormous continued hikes. So now above 4% Fed funds rate a year from now. So that's a big shift in terms of expectations from where we were, even a month ago. So I think it's just, people seeing that inflation unrelenting in terms of the CPI, and the Fed is so far behind the curve. They're still below 1% in terms of the Fed funds rate that they have to do something. So what does this table tell me? It tells me, again, coming back to that point of you can't pick the historical analog. Well, if this is different than any bear market in the last 40 years, we're likely to see something different going forward as well, right? Just because this is a big shift, right? And we don't know how long they're going to hike. And at some point, of course, they'll stop or shift. And as soon as the inflationary pressures ease, I expect them to change the narrative. But we're not there yet, right? It seems like there's not enough pain yet for the Fed to stop the path, right, of trying to normalize interest rates. And that's all it's been so far, is a normalization, right? We're not even at 1%, as we talked about.
Yeah. So again, we'll probably get into a few more questions around the bear market, but just to keep things moving along here. kind of interesting to think about that market and the inflation that we just talked about, but also, how that's affecting the consumer and spending behaviors. So your first chart here, looking at something that's been very conversational, which is gas prices and spending there. But let's talk about this for a second.
Yeah, this is, as we've talked about, this is important because it's inflation. Embedded in inflation are expectations, and expectations are built on experiences and what people are talking about with their friends and family. And this has just been a constant conversation. We're seeing new all-time highs in gas prices, now above $5 a gallon on average in the nation. California is over $6 a gallon, and this is very important because most people drive, and if your incomes are not going up in tandem, which pretty much no one is, with these increases in gas prices, and not just gas prices, but obviously electricity, heating oil. We talked about many different areas in terms of inflation. Well, that's going to lead to you feeling not as good about the economy, not as good about your personal situation, and this obviously is driving many different things in the economy. Certainly driving what's going on in part in the stock market. So, I think we wanted to ask people, since a lot of people look at the price of gas, the price of food, and things like that, and feeling uncomfortable about it. We wanted to poll everyone to see, ask them, how do they feel? Do they believe we're in a recession today or not yet in a recession? So pretty simple poll here. Do you believe the U.S. economy is already in a recession or not in a recession yet?
All right, we'll give everybody a minute or two to answer that question. While they do, I think we can jump into the next slide here, which is moving away from gas prices and just talking about consumer sentiment and where that's at right now in relation to, kind of recent trends.
Yeah, so this has been an issue for a few months. We've seen it just steadily trend lower and lower as inflation has gone higher and higher, and we'll talk about wages not keeping up with that in a bit. But if you go back in history, this is the lowest. This goes back to 1952. This index, a pretty long period of time. We've never actually seen consumers this negative, so consumer sentiment this low, which is pretty remarkable considering what happened in 2008, of course, and of course what happened before that in the 1980s. And we've talked about that 73, 74 decline. So even in the midst of stock market declines that were much larger than what's gone on today, it's a very quick, I think, adjustment to it. And I think that's a reflection of a few things, but mostly just that people haven't seen this in their lifetimes. Is something such a shock. It's so new to them that inflation would be a concern, and it's front and center. And so if we're in a recession, I don't think that would surprise many people given where this index is, right? So the tendency, and we've seen some exceptions. We've talked about 2011 consumer sentiment collapse, but it very quickly recovered during the bear market during that period. But other than that, when you've had sentiment this low, it tends to lead to, at some point, a shift in discretionary spending. And so, we're hearing from companies like Walmart, Target, talk about that shift where they're seeing the consumer start to purchase more of that necessity items, right? Like food, lower margin products, and less of the things that you don't need but you want, so electronics and things like that. So maybe that's the early stages of it. We haven't seen it in mass just yet. We've certainly seen travel numbers continue to be strong, and entertainment and things like that still seem to be strong for now. But the question is, at what point psychologically do people make that shift and say, I'm just going to hold off, right, and to see where things goes? I'm not feeling comfortable here. Maybe I won't take that weekend trip because of gas prices. It's incredible, yet we haven't seen it yet. So AAA has been saying, and I've been watching the weekly demand numbers for gasoline, and it's still strong. So even at $5, people are still spending for now, and still driving, and still doing things. But the fear, of course, is that this in time will translate into that pullback.
Yeah, indeed. All right. Well, Alex, if you're on, let's flip up the poll results here and see what the people said about whether or not we're in a recession. Pretty close. Wow, maybe our closest poll yet.
Interesting. Yeah. Okay. So we had a little bit more of an optimistic group. I did this similar poll on Twitter last week, and I think we were at 59% in a recession. So that's good. We got some optimists on here, and we'll come back to this in the future to see how things shake out. But I think we have a graphic from the last few webinars, right?
Yeah,
talking
indeed.
About, yeah.
Indeed. So we went back to the last two webinars to see how responses from those polls compared with where everybody feels about where we're at right now, whether we're in a recession or not. I think we asked a question back in April, when will that recession be? And a little over 60% of people said it was going to be in 2023. Mm-hmm. And, another 24% or so said it'd be 2024 or later. So that 15.8%, if you contrast that with the 49% that think it's happening right now, definitely shows a shift in expectations amongst people, right, Charlie?
No question. Yeah. So for all the reasons that we've talked about, yeah, the fears of recession have gone up. No question.
All right.
And then did you want to touch on that? What was the other one there?
We can go back real quick. Let's see.
Yeah.
Yeah. So looking at
right,
what the
January. Okay. So that's been settled. So we were asking back then, it was only a 12% decline, I think, at that time for the S&P. And we asked if it was going to be a full-fledged bear market or stop there, that being the low, or somewhere in between. And I think most people thought optimistically that it wouldn't get to 20%, but I guess 20%, the 20%, if you said bear market, you were right there. Yeah.
I like those, the 13% of people that thought that was the bottom.
Yeah.
Wish that turned out to be the case.
It was a long time of buying those kinds of dips, so I can't blame them.
That's right. All right, but continuing the consumer track. So here we've got a chart looking at retail sales, but also kind of how those sales are adjusted for inflation, which I think tells a much different picture on the far right of this chart.
Yeah, so sales are still hitting new highs, and I guess with inflation at 8%, that shouldn't be a surprise because, this is a dollar amount nominal of sales. So if prices go up 10%, you're going to be seeing sales up 10%, all else equal, unless the quantity goes down, right? And we've seen continued demand. But even if we adjust, I think the important point on the bottom chart, we'll have an updated number this week, so we'll see how this shakes out. But if we adjust it for inflation, retail sales are still holding up. They're not they did peak last year after that third round of stimulus, which is not surprising, but they're not collapsing just yet, which means that the U.S. consumer, irrespective of inflation, is still kind of maintaining that high level of spending. Like if we go back to pre-COVID levels and we fast forward to today, it's still a very high rate of growth between those two periods times, much above the average that we saw the 5 years, let's say, prior to that. So I think the big question is, well, how is that possible? How is the consumer still holding up given this? And the way I look at it, there's two kind of big factors driving, that are really driving the reason why consumers are still able to spend for now. Even given higher prices outpacing wages. And the first is just savings. And so this chart will forever be distorted because of those three stimulus. You could see the spikes there, the first stimulus being the biggest. And if you're given money, you're going to save part of it. And people did that. But we're now well past that. And what we've been seeing over the past year is just a steady deterioration in that personal savings rate down to 4.4%, which is the lowest since 2008. So you have a choice, right? Prices are going up. Your income isn't going up as much. Do you spend less or do you save less? And so far, people are saving less. That's one of the factors that's driving, that retail sales number staying high. Number two is the good old fashioned American way, which is if you can't afford it, you borrow it. And So consumer credit now is going up at a pretty rapid pace. Now it's up 7.5% year over year. That's highest since 2011. And so, that's a choice as well for now. If maybe people are thinking we'll get past this, I just want to, need something for the next few months, and hopefully inflation will start coming down again. So for now, these two factors are really the big drivers of why retail sales hasn't collapsed of yet.
All right. So retail sales, obviously something, everyone's keeping an eye on from, the individual investor consumer standpoint. But maybe a bigger part of their financial picture, and something we've already seen a couple of questions on here today, continued interest in the housing market, especially with what's happening with interest rates. So let's move on there and talk about a few things.
We could quickly run through this. It was, been a constant topic over the past year, and we've just seen in terms of the gains and an acceleration, right? And 38 consecutive months of all-time highs for home prices in the U.S. The increase over the last year, 20%, is the largest on record. This data is lagging by a few months, but it's still pretty remarkable. So the question is, is this a second housing bubble? Just looking at the data, it seems to be. If we're looking at a relationship of prices to incomes, or we're looking at any number of different metrics, it seems stretched on a fundamental basis. And if we're looking at what's happening on the next chart, I think with mortgage rates, this is something we haven't seen since the 1980s, where the spike in mortgage rates, and only in 1987 do we have a faster spike in mortgage rates than we've seen this year. It's pretty remarkable. Now, mortgage rates have doubled since the lows in early 2020. And what we're seeing, as we talked about in the last webinar, is instead of prices coming down, we've seen just transactions plummet. So there's weakness there. Demand is going down because affordability has collapsed, as we'll show, but we're still seeing the average price of a transacted house going up and hitting new highs. So this is somewhat of a mirage, as we know, because as soon as that supply comes back on the market and people feel like they can't wait to sell their homes, and that'll change, right? There has to be a give there. So if we're looking at early 2020 versus today, Caleb, if we look at that mortgage payment, that monthly mortgage payment, it's almost doubled over that period of time. And now, of course, home prices are 30% higher than they were in early 2021. So you need a bigger down payment, and so all of those reasons suggest that we should see a correction in the housing market because affordability has just plummeted. So this is housing affordability index going back in time. We're now at the lowest level since 2007. We know what happened after that, of course. And what's driving this? Prices going up, interest rates, mortgage rates going up, and income's not going up as fast, as those two factors, right? So those three things drive affordability, right? So,
and another example here too, Charlie, of lagging data, right? So we expect the next few prints of this to probably get even worse.
Yeah, this is as of April. Good point. Yeah, and so mortgage rates have continued to rise, since then, and so affordability is actually even lower, than what this is showing. And so for all these reasons, you expect to pull back in demand. Most of the housing market is still financed, and so if that's the case, and you can't afford, if the average income can't afford the average house, well, then their demand has to go down. And so we're just starting to see that. If we look at things like new home sales, we're just seeing a collapse in that because prices haven't adjusted yet, and people are trying to get a mortgage, and the lender's likely saying, well, no, we can't do that. It's not going to work. You're based on your income.
So this next chart, if I'm understanding this one correctly, it's just saying that right now homes have appreciated at 130% the pace of inflation. Is that right?
130% above, right, the rate of inflation. So this is a chart going back, 1890s, right? So long time. And for a long time, housing prices more or less, deviations, of course, but more or less tracked the rate of inflation. And that should be intuitive for people, because the house at the end of the day should be a function of a few things. How much it costs to build a house being one of those things, which tracks the rate of inflation, and the other being your income, wages, which tends to also track the rate of inflation over time. And we've seen two big deviations from this historically, one being during the housing bubble in the mid 2000s. And then we had, pretty sizable correction after that. And now we've had a second run up to even higher levels than back then. So if we called that a housing bubble, then just based on the facts and the data, you have to say that this is a bubble as well. And we have to question why the Fed really engineered two housing bubbles in the last 20 years, particularly now that they had the knowledge of the first one, and driving interest rates down to 1% back in 2003 and keeping them there was one of the primary causes for that housing bubble back then. And then this time around, driving them to zero, even though home prices are hitting new all-time highs, and buying mortgage bonds, as we've talked about, almost insane, buying mortgage bonds every single month, driving interest rates lower when you had a housing market that was on fire. So there's plenty of blame to go around, and certainly psychological speculation is always going to be there and part of it. But the Fed didn't need to throw fuel on that fire here, and so now they've done it again, and we'll have to see how much they'll let the market come in, essentially. And this could come in one of two ways: or time or price, right? It could be like Japan, where just prices don't go anywhere for 20 years, or we could see a correction like we saw following the peak back in the last housing bubble. And so this chart here is just showing that the adjustment has started in terms of affordability. Affordability plummeting leads to lower demand, and we're seeing the lowest new home sales since April 2020, which was, of course, during the early stages of COVID, when people didn't know what was going to happen, and it was before people got the stimulus payments and all the rest of it. So that's a pretty sizable move down. Housing is an important leading indicator for the economy generally. So this is not something, if you're looking at recessionary signals, we've talked about the yield curve in the last inverting on the last webinar. But after that, and that tends to be a longer leading, after that, the housing market tends to be a pretty consistent leading indicator of a downturn in the economy. So if this were to persist, certainly the odds of a recession go way up.
When you think about the housing market, Charlie, I mean, everything you said creates this situation where, supply wasn't there and there was a ton of demand. For all the people in the market that weren't able to find that new home or buy that new home over the last couple of years that maybe there was demand for, are you expecting that demand to get curbed by the high interest rates? Or do you think as housing prices come down and kind of that affordability sells in, that demand will continue to go out and snatch up that supply and kind of prevent a huge crash like we saw back in 2008?
Yeah, people want to own a home. You get to that certain stage in your life and household formation, you're having kids, and the demand's there, right? There's certainly, we've seen that. So it's really not on the demand side. It's like it's in terms of just demographics, right? The demand is there. We could use more homes, and home builders were building, it's just not fast enough to kind of balance out that equation. But at the end of the day, housing you want it to be affordable, which is why I've questioned that policy from the Fed. In terms of pushing, asset prices, particularly in the housing market, higher. It doesn't benefit anyone except in the very short term to drive prices way above fundamentals, to drive prices way above incomes. It's not a good thing, right? If you're living in your home, your housing price goes up. Maybe you feel great about that. You might spend more money in the short term, and that's kind of the wealth effect. That started under Bernanke, and he's like, that's why we need to support the housing market and push these kinds of policies. But at the end of the day, it has to be affordable based on income, or you're going to have this situation where it's so disconnected from reality, and people are spending so much of their income on housing that's crowding out other areas of the economy, right? That actually generate real economic returns, right? So housing is not an exportable good. It's not an area of the economy. It's something everybody needs and certainly wants, but it's not something that is going to lead to an increase in long-term economic growth or prosperity. So you want just housing to be affordable for people, ideally, and them to innovate and spend money and save and invest in other areas of the economy that is an exportable good that does improve the lives of many people. And whatever that area that may be, the market will determine that. But you don't want the housing market in terms of overinvestment or people speculating or just simply driving prices up to irrational levels. What does that create long term? To me, it's just it's beyond foolish. It's just an irresponsible policy to have. And hopefully, after this, we'll have learned the lesson that you don't want to. A certain extent, the market's going to move the way it'll move, but you don't need to be encouraging that in that direction. If something's already unaffordable and already has strong demand, why are you trying to engineer it and manipulate it higher? So I think those questions should be asked. Hopefully, someone asks that question tomorrow to Chair Powell. I'm not optimistic that they will.
We'll see.
They won't let me in to the press conference.
We got to work on that. We'll get a
petition. Please, if you know someone there,
all right, Charlie. Before we jump into the next section, I'm gonna address a couple of questions that have come up.
Okay.
We've got a lot of people on. First one is the charts. All these charts that are going to be made templates, which will be available on YCharts. So you should be able to go into our fundamental chart or technical chart, grab those templates. If you don't have access, you can sign up for a trial. But Charlie, you've also always said that these charts, as annotated with all the visuals included, can be grabbed from your blog as well, right?
Yeah, taken from the blog, Twitter. If they're helpful for you in communicating to your clients, or just you want to share them with friends or colleagues, please do that. The goal is just to get as much meaningful information out there, and so the more people find it useful, that's great. That's awesome. Please keep doing that.
Awesome. And then the second thing, in the event that we've got two more sections here to cover, in the event that you're
trying to preempt us running out of time.
We're not gonna, but if we do, we are going to record this and we'll send it out to everybody tomorrow. So
good.
I wanted to make everyone aware of that. But let's jump in. The big question: what's the only path to long-term prosperity?
Yes. So, and I think it's what a shift we've seen. What an 180-degree shift that we've seen in the American psyche since the early days in 2020, where there was this notion, as we talked about, that there was really no consequence to printing money or borrowing and spending, that there were only upside to that. And the evidence that people pointed to at the time, and you could have pointed to any number of things, the stock market, but their wages was a big one, right? Your wages are finally going up and meaningfully going up, after a long period of stagnation, and which is obviously great news. All else equal, the problem all else wasn't equal, and so this is what I've called the wage growth mirage, in that wages have increased 12% since early 2020. But if you adjust for inflation now, they're actually down over that period of time, which is pretty remarkable. So nominally, you might be feeling like you're making more money, but then when you go to the grocery store or the gas pump, that's why consumers are so negative, because now they're understanding that free money isn't free, and the ravages of inflation are important too. So what I say is the printing, you can't print your way to prosperity, right? The only path to prosperity in the long run is creating real economic value for people. And so whether that's technological innovation or scientific innovation, we've seen industrial revolutions, right? All of these things have increased the well-being of mankind over the past 200 years, where any period of history doesn't rival that. So, I'm very much an optimist on where we were and where we're going to be in the long term in the future. But this notion that we've had that you could kind of change that formula and instead of creating real value, just artificially, literally create more dollars, and that's going to create wealth for people. Hopefully that's been proven wrong, and we've done it in the past, and it's been a long time. But so the lessons have been forgotten, but that lesson is one constant throughout history.
All right, and moving on to the next chart here.
Yeah.
I know this is actually something we've talked about on several of our past webinars too. Fielded a lot of questions around the money supply. What will it take for that money supply actually to begin to contract? We're just starting to see it, right?
Finally, right? Yeah. So this is a big change, and so to that last point, I think we're finally moving in the right direction, and this is a good thing. And if you want to see inflation come down, this is one way to do it. And of course, the adjustment's going to be painful, as we've seen. You can't go from increasing the money supply by 40% and then now decreasing it without some pain. But in the long run, this will be a very good thing. So we've had 144 consecutive months where we saw the money supply increase, so 12 straight years. And we had the first decline that we've seen since 2010 in that. And I suspect that this should continue, right? The Fed is now unwinding their balance sheet. Deficits are shrinking. So we're very rapidly moving in the opposite direction. So on the next webinar, we could very well be talking about money supply growth, at close to zero, something we haven't seen, in a long time. So again, what a change in the way the American people are thinking about inflation. And who could blame them? They hadn't gone through it in 40 years, so it wasn't a real risk for them in early 2020 to be thinking about that. But now they'll have the battle scars that that people have talked to us about, that we kind of just shrugged off. Oh yeah, the 1970s. I don't want to hear about the 1970s. This is the new world, and we don't have to worry about such things, pesky things like inflation. So this is a good sign, Caleb, and we should all be cognizant. We had a choice to make. We could have kept doing it, right, and just said forget it. But thus far, we're taking the choice, saying, okay, there's going to be some hard times, but the other option is not an optimal solution, right? If you look at Venezuela or Argentina or anywhere that's had hyperinflation, you don't want that, right? So that, even if in the short run that feels good, we cannot let that even come remotely close to being a possibility here. So the long-term prosperity of the U.S., I'm very bullish on the next 100 years, but we're going to have to take pain. There has to be corrections and recessions to clean out the excesses. And we didn't really take the medicine in 2020, right? It didn't feel like a real recession for all the reasons that we've talked about. And so now we're really having the first downturn that we've seen since 2008.
And we're seeing maybe some signs of that too, with the relative strength of the dollar, despite all the inflation, right?
Oh God, the dollar. Yeah. So I'm sure there's a few questions about the dollar as well, right? Why is it so strong? And in the face of all of this, and as we talked about in the last webinar, it's all relative, right? You have the ECB, who still has negative interest rates, as crazy as that is, with 8% inflation there, but they too seem to be understanding, and they're now talking about stopping negative interest rates over the next few months. For the first time since 2014 when they started it. And then you have Japan, and it's just a totally different animal, right? They just keep on doing it. They're ignoring any sign of higher prices, and they'll just keep on buying government bonds there and doing what they do, I guess, until it reaches a breaking point. So yeah, so the dollar is strong versus those things. All
right. Let's talk about some honey, right? We promised to find some honey in the bear market.
Maybe
we found a little bit already. We talked about how housing is going to become more affordable.
Yes, let's
yields
hope
might get
so.
better.
Yeah, that's right. If you don't own a home yet, that will be a welcoming sign if housing becomes more affordable. But what's the upside, downside for long-term investors? If you're a saver, you're adding to your 401k, you have every month, and you're reinvesting dividends. You just have a longer term time frame. The benefit of prices going down in the bond market and yields going up is that future returns will likely be better. It's the stock market's a tougher animal to crack because sentiment drives everything, particularly in the short run. But the bond market's pretty straightforward. That beginning yield, as we can see in the table on the right side, the chart there, there's a very high correlation between the starting yield on bonds and the forward returns over 7 years, right? And so we were all the way in that 10th decile in terms of starting points. We were even below that because we didn't have a 7-year period, but of course we went below 1%. But this is covering just 7-year periods. But now we've moved to that 9th decile. So better. You should be expecting better returns from bonds over the next 7 years than we've seen in quite some time. So the 10-year treasury yield's highest since 2011. This is from yesterday. Today it's up even more the last time I looked. So if you're a longer term investor in bonds and you weren't a buyer of bonds at 0%, but now you're saying, well, I could get 3.5% over the next 10 years. Now that might be good or bad depending on inflation, and the way interest rates go will determine the short-term movements, right? In that, but the long-term, if you buy a 10-year bond, 3.5%, and you hold it, you're going to earn that 3.5%, right? So that's the upside of downside. And the more yields go up, the more painful it'll be in the short run, but the more that equation will change, right, in the favor of investors. So if we see a 4% 10-year, okay, now your expected returns have moved up to 4%. And this is just showing government bonds, high yield bonds, similar. So high yield bonds just a year ago, I'm trying to remember if we talked about in the webinar. I think so. It was an all-time low, below 4%. It was just an unbelievable thing to see. Junk bonds below 4% in yields. Irrational exuberance if I've ever seen it. And now just yesterday, junk bond yields went above 8%. And so they've more than doubled. Could they go higher? Absolutely. They could go 10, 11, 12%. We've seen junk bond yields at 20% in 2008, but that's a better risk reward, right? And you're at least now getting closer to the rate of inflation there. So in pretty much most asset classes that have gone down, you've seen an improvement in these long-term return expectations.
Yeah, I remember talking about that, Charlie. We were looking at how investors had to move way out on the risk curve to get the yields that they needed to support income portfolios and things like that. So yeah, this makes a lot of sense. And then let's flip to the next one here and talk about value.
And so, right. Yeah. So the left side is the CAPE ratio. This is as of May. It's a monthly thing, so it's a little bit lagging. Now we're back below 30. But as we talked about last year, the CAPE ratio was at the highest level since the dot-com bubble, right? It never got to that peak, but it was really the second highest in history. And what that portended was lower forward returns. The right table there shows you the relationship there. Highest valuations, lowest future returns going forward. So prices are down 22%. Valuations have gotten cheaper. Forward returns have gone up. Now we could debate how much they've gone down, and is it certainly you couldn't say with a straight face that stocks are cheap here if we're looking at something like the CAPE ratio. Looking at trailing 12-month earnings, a PE, now we're under 18. The earnings could come down, and that would push that up. But the point is, better than it was where we entered the year, right? So if you're a stock investor for the next 10 years, you should be expecting higher returns than where you were at the start of the year. And if the S&P goes down 50%, and this is one of those long and deep bear markets, well, then you're going to get into these better valuation deciles. Like the last time we saw us in a decent valuation decile was back at the March 2009 low. So, back then, if you use this formula, you were talking about double-digit forward returns for equities. We ended up doing much better than that because valuations increase. So the upside of downside is that fear is good. And so like, that the lesson from Wall Street, Gordon Gekko, is that when it comes to investing, he was wrong, right? Greed is not good. It didn't end up being very good for him either. I think he ended up going to jail. But in investing, fear is good because fear creates opportunity. Fear creates higher yields, lower valuations, all the rest of it. And it creates opportunity when investors get overly negative, like they were in 2009 and many other times in history. When they can't foresee anything good happening in the future. I'm not sure we're there yet, but we're certainly getting closer to that point every single day. Well, that's historically been a better time to buy when there's just so much fear out there. When you think things can only get worse, that's been more than priced into the market, and you tend to have then upside surprises, right? Because you need more negative news to push us lower, right? So certainly, if you're a long-term investor, these are things that you should be encouraged by.
All right. Well, we're just at the top of the hour, which means we pretty much did our job here. We got through the slides. Well, if it's okay with you, Charlie, can we tackle a couple of questions?
Yeah, let's do it.
All right. So one, I guess, leading off what you were just talking about, valuations. Yeah. One question came in. When you're looking at guidance on forecasted earnings, why are those forecasted earnings being adjusted downwards more based on what's going on in the economy, and why aren't we seeing like forward PE ratios drop a lot?
Yeah, it's very slow to react. We saw something similar in 2008 during that recession, and we saw something similar during 2000, 2001 during that period of time. Investors are just, until they actually see it in the data, they're very slow to be convinced, I think, that earnings will take a hit. So if we're looking, though, already, let's forget about the forecast and just say where we are in terms of earnings. Year-over-year earnings growth is flat now, year-over-year. And that's first quarter earnings, right? We'll get, in a few weeks, we'll get second quarter earnings, but first quarter earnings were flat, and they were down from where they were in Q4 2021. So I think they were down around 15%. So we've already seen a little bit of an adjustment. But I think the expectation, it's similar to the kind of the forecast that I always laugh about every year in terms of the S&P forecast. And we talked about at the end of last year, every single one of them was wrong last year. They were under the market, and this year every single one of them would be wrong in predicting that stocks will go up, and now they're down, right? Similar to that, long-term earnings growth in the S&P 500 has been around 6%. And so that's kind of the base case scenario, unless you have, obviously something like we saw in 2020 where that, things change and, rapidly in one direction or the other. That's kind of the base case expectation, that there will be growth, and if things go down, they will recover, until you see evidence to otherwise. So I have no idea how much earnings will go down, but there's no question we're seeing margin compression. So that's going to be an issue. It was an issue in the first quarter, but likely be a bigger issue this quarter for companies. So even without sales coming down, you're going to see pressure on earnings because they're having a more difficult time passing those costs on. As we talked about early on in the pandemic, if you looked at like the home builders, what they were saying, like the price of lumber, if you remember, it spiked to huge levels. And then home prices are going up, and home builders are increasing their prices. And then the price of lumber collapsed, and I think it was Toll Brothers, one of the calls I was listening to, and they asked, well, are you going to adjust the prices back down? And they said, no, we're going to take it. He said, we're going to take it to margin, which means we're going to take that profit, that extra profit, right? And so now we're going to start to see the other side of that, where they're a company like Walmart, they want to be the go-to for low price, having the lowest prices that people can rely on it. And they've been reluctant to raise things like food prices because grocery is such an important entry, right, into getting people to come into the store. They're reluctant to raise it as much as food prices have increased, right? So they're thinking long-term as a corporation and saying, let's take a hit to profits in the short term and retain these customers and maybe even gain share, for the long run, right? But that's an adjustment that we're just starting to see. So certainly, if this is a recession, earnings are going to come down, significantly. But just remember, stock market's leading indicator of that. So stock markets are going to bottom well in advance of when earnings turn around, right? So,
all right,
keep that in mind as well.
All right. Well, let's take one more question. Let's tackle, the perennial question of commodities, right? Everything from oil to gold. Give us the quick take. We didn't touch on that today. So
so commodities in general, we'll put gold in its own class. Commodities have been, as they were during the 1970s, the best inflationary protection in a stagflationary environment. We've seen that incredibly this year, right? Price of crude oil, right? Gasoline, just a broad basket of commodities still rising significantly. And as we talked about in prior webinars, that's been one way. If you believed in a stagflationary environment, that should have been the bet you were making. And we talked about why shouldn't it be using something like tips? Well, unfortunately, tips have duration. Tips are down. I think last time I looked, 8-9% this year. So if people are wondering why that is, well, they're not. They're still subject to interest rate risk. So when interest rates rise, they're still going to be hit by that. So commodities, if you want to talk about doing your job, commodities have done their job in the portfolio in terms of protecting against that stagflationary type of environment. But the question, at this point, with if you look at energy stocks or the broad commodity basket ETFs, up 50-60%, right? And some even more. The question is, if and when this becomes a real recession or demand is hit, are we going to see something like we saw in the back half of 2008, where energy prices collapse, right? And things change at a certain point. For sure, that's going to happen. It's there's only a matter of time, right, before you either have supply catching up with that, right, or just the demand side easing and prices come down. But in terms of portfolio, there's been nothing better this year in terms of, like, over very long periods of time. As we talked about, stocks, commercial real estate have been the best commercial inflation hedges. But in a stagflationary environment, that really equation changes. And as far as gold is its own animal. It's doing its thing, no correlation. The worst thing for gold is rising real interest rates. And so we're starting to see that. I think that's a main reason why gold is having some difficulty this year. It's certainly done better than stocks and bonds, but gold is a very, as we talked about, it's an enigma. And sometimes it behaves like a currency, sometimes like a commodity, sometimes like something else entirely. And so if you have it in your portfolio, that's why you have it. But trying to predict when it's going to serve its purpose has historically been pretty difficult. Gold actually does pretty well during deflationary type bear markets, and so perhaps this is not that, and so that's one of the reasons why. But look, it's surprising to me. I think it's surprising to a number of people that gold hasn't done better.
All right, well, we should probably wrap up. I guess just to maybe take put a takeaway out there, something that you always remind me of, Charlie, every time we talk, is everything that's in your portfolio, if it's constructed properly and well diversified, is there for a reason. And, as these situations happen, it's tough to look forward and say, what's the best thing to have in your portfolio. But if you stay disciplined, you can look back and usually say, hey, it's a good thing we had these few things in our portfolio because that's why they were there. So, yeah,
just think about every possible outcome that's reasonably possible outcome that could happen, and ask yourself whether you're protected against that, knowing that it's not going to be perfect. And in a year like this, if you have stocks, bonds, like commodities, even if you had a diversified portfolio, you're still going to be down. You're still, unless you put everything into that commodities bucket, you're still going to be losing money. And that's okay, because being diversified means something is not going to be working at any particular time, right? Like if we all knew the future, we would have just put everything right into crude oil and went home, right? And,
That's right.
6 months ago, right? But since you can't predict
You
the
didn't?
future, you have to balance that. No, you have to balance that risk versus everything else, right? And so there's a time for everything, and there's a cycle to everything. And in terms of the tough year that it's been, this will pass. It may get worse before it gets better, but in the long run, I'm a big believer that an optimistic outlook is better certainly than a pessimistic one. And we'll get through this just like we got through 2020 and every bear market and recession before that.
All right. Well, Charlie, thank you so much for joining us again. I'm sure we'll be doing this again soon. And if activity stays the way it is in the markets, maybe sooner than later. But certainly appreciate it on behalf of everybody. Thank you for the insights and then for everything you provide on an ongoing basis too. So
awesome. Thank you.
Talk to everybody soon.
Thanks, everyone. Have a good one.